Hello, welcome everyone to this webinar about the 4 key elements of digital trust. I am Santiago del Puerto. I am a product manager here at Fitsai. I've been working for 2 years here at Fitsai, and overall I have more than 7 years of experience in the payments industry. These last 2 years more focused on fraud, helping Fitsai to develop their roadmap and their products for transaction fraud. And today I'm here with Ana Vicente. I will let her introduce herself.
Well, hello everyone. My name is Ana Vicente, and I am a risk strategy analyst here at Fitsai. I basically just finished my business management degree about 12 years ago, and I started to work right away in the payment and the banking industry as a chargeback analyst for different banks here in Portugal. And in the last couple of years, I've been working at Fitsai, basically helping our product team to develop solutions to fight banking fraud, and also I've been working closely with our clients to understand their needs and also their use cases regarding fraud prevention and fraud detection. And so, yeah, I believe this is it. So, Santiago, I think you may proceed with our presentation for today. I hope you all enjoy it. Thank you for coming.
Thank you. Thank you, Ana, for joining me and for all the work you are doing with us at product here at Fitsai. So what does digital trust mean? Well, digital trust in general, we can say, is the foundation for a business to succeed. And more in the digital world, trust will be the basis, everything that the business needs to be successful. And digital trust is just a mechanism for the companies to measure the confidence they have in their clients. So financial institutions, banks are not an exception to this, and they need to feel secure and confident with their clients and to then maintain relationship with them along the time. Last year, the COVID-19 pandemic caused a massive disruption in all of our lives. We started to live a new reality, a new normal, which brought a rapid transition into the digital age. So the kids started to connect to their schools through teleconferences, all of us workers connecting to our offices, to our colleagues, through Zoom meetings, consumers buying groceries online through different online platforms, and financial services as well. Their customers started to connect to their banks through home banking channels via online, web or mobile channels. Now that physically going to a branch or to an ATM is considered a risky activity. So the banks, the fintechs in general, had to adjust to this new normal, to this new reality. And for that, they started creating new channels for their customers to operate. Well, first to open accounts, make transactions, everything from their homes. This is great for the customers. However, unfortunately, all these channels also open new opportunities for fraudsters, and fraudsters are being very creative in the ways they are using these channels to commit any type of banking fraud, account takeover, impersonation scams. So we can say that for banks, the real challenge was not technological, was not how to develop and build those new channels. The real challenge for the banks was to, if they could trust the person on the other side of the screen. And we can see this also a bidirectional relationship. So imagine when a fraud is successfully perpetrated, it can compromise the trust that the clients have on their banks, and ultimately can make the clients to move out all their funds to a competitor, making the client the bank to lose one client. But on the other hand, it's equally important for the banks to determine if the person transacting behind the device, behind the screen, is who they are saying to be. In other words, if the bank can actually trust their customers as well. So the last year brought a massive adoption on all these online new channels. And this made also fraudsters to use these channels with sophisticated mechanisms to commit unprecedented rates of fraud that we've never seen before. So at FinSec, we've made a study comparing the first quarter of the pandemic, the first quarter of last year before pandemic to the last quarter of last year. And we've seen a 650% increase in account takeover scams. And at the same time, a 600% increase in attempts to impersonation scams. At the same time, during last year, we've seen a huge increase in the adoption of online banking. And it does not only mean that new customers are adopting this channel, it also means that fraudsters are mixing among legitimate bank customers. So we can see here in the graph how online banking experienced a 200% increase in attempted fraud last year. And this is way much more than the fraud rates experienced through traditional channels such as telephone or branch. So all these numbers just show us how important it is for the banks to determine if the person transacting behind the device is the owner's account, is who they say to be. So for that, to handle this rapid increase that we've seen in fraud rates, banks had to step up into the customer journey using authentication mechanisms such as multi-factor authentications, biometrics verifications such as Face ID verification, fingerprint scans, OTPs, one-time passwords, limit the number of login attempts, some manual review processes. And actually, if we go back, we can see that all these numbers all these make the number to decrease. So at the end of last year, we see a decrease in the fraud attempts. However, as effective as these are to prevent fraud, they are equally effective in creating friction, frustration in the clients, basically preventing the clients from having a great banking experience. And also banks must think that many of these customers that made the switch to the digital area did it reluctantly. They didn't have any other option because bank branches were closed. So they were forced to move to this digital age, to this new normal, as we've seen. So banks started to feel more pressure to make the user journeys more seamless, to improve the customer experience across all their journeys. And to do this without stepping up into the flow, they should start looking into passive ways to monitor the customer in background. So analyze quietly the behaviors, the devices, all the aspects of the customers that can essentially make the banks identify what's normal for a customer, build a legitimate customer profile, and then identify deviations that can ultimately be signs of fraudulent activity. So we can see that all these new systems, all these demands generated a lot of challenges for the business and for the banks. However, all these also generate new opportunities. They bring new interactions between the banks and the clients, new digital interactions, and all these data points need to be used by banks in a smart way to develop roadmaps to improve the products in order to deliver a more personalized experience, better products that can help to satisfy the demands of their customers, but also to detect and, more importantly, prevent fraud before they happen. So banks can use artificial intelligence, machine learning solutions, partner with the right companies, and leverage these tools to stand apart from their competitors and make real changes into the customer experience. So what we are seeing here is the typical home banking session. After the registration or account opening process, the user will typically log in into the home banking or mobile app platform to interact with the bank. And at this point, it's particularly interesting to look for some of the patterns, like what's the login frequency for this customer, what's the time between the username typing and the password typing. Did he actually type the password or did he copy and paste? So all this is important to look at the login stage. But after the customers or the perpetrators, is in some cases, get access, logs actually into the home banking account, apart from creating payments, they can usually do some other activities like update information about the account, update settings. So it's particularly interesting to look for password changes, for changes on the security settings like multi-factor authenticator getting disabled, changes on the biometric settings like the Face ID, the fingerprint used for authentication. So it's important to look for changes on the email or the phone number, because essentially if a fraudster get access to change the email, they can then do a password reset and get full control of the account. So also in general, across the whole user journey, it's important to look for other aspects like behaviorals, like as I mentioned before, the writing patterns, typing speed, the number of mouse clicks and the travel velocity of the mouse, the time spent on each page, also things like related to the device information, like what's the typical language this user is used to use, what's the typical device, brand, operating system, screen resolution, geolocation. So all these are just some examples of digital activity and behavior that can be analyzed through machine learning models to build what is the genuine customer profile and detect variations that can let the bank to identify fraudulent activity. So let's now look at all these elements in a more structured way. So how can we classify them in what we call the 4 key elements to build digital trust? The first one is identity. Identity refers to identifying the true identity of who is transacting behind the device. The second one is the behavior, and behavior is the ability to identify patterns on what's the normal customer's activity. But as I mentioned before, the typing patterns, the mouse travel velocity. Number 3 is device. These are all data elements related to the device information, such as language, screen resolution, device type, browser if it's a web application. And number 4 is IP. All data elements derived from the IP of the customer, such as network provider, geolocation, proxy detection. So now Anna will show us a little bit more in detail each of them and what threats we can prevent by looking at all these elements of digital trust.
Well, thank you, Santiago. So, like Santiago mentioned before, digital interactions with financial institutions are getting more common as we speak. But also account takeover and authorized push payment fraud scenarios. So financial institutions must ensure that their customers' accounts are protected from both ongoing and also new online threats. And also customers need to feel safe and to trust the financial institutions they are working with. We have to understand that a fraudster can get access to a personal account through all sorts of techniques. He can use social engineering techniques. He can use brute force attacks like credential stuffing. That is a technique that fraudsters use to test multiple combinations of usernames and passwords. A fraudster can also use phishing, vishing, and smishing attacks using phone calls or even text messages to target their victims, and all sorts of techniques to break into someone's accounts. And the main question is why does a fraudster want to gain access to someone's account? Well, he wants to steal money and he wants to steal personal information, and then he can use that particular personal information to open fraudulent accounts and to also sell that particular information on the dark web. And when a fraudster breaks into an account, he can perform all sorts of actions on behalf of the account owner. For example, he can change the password or the biometric settings and keep the customer out of the account. He can change the account email or the phone number to start receiving all notifications and communications like two-factor authentications or payment confirmations. He can also reset trusted devices and disable multi-factor settings to avoid a second level of security. He can also provide the account with stolen cards and move funds across multiple fraudulent accounts, and so on. So that is basically why financial institutions must be able to recognize the identity of their genuine customer. To, on the other hand, have the ability to reduce the friction on those genuine customers, and on the other hand, to monitor customer activity and to spot some anomalies or changes that are vital to fight account takeover and authorized push payment fraud. Santiago, can you move to the next slide, please? Okay, thank you. So once again, why does a fraudster want to gain access to someone's account? To steal money and to steal personal information. And again, the fraudster can break into an account through all sorts of techniques, and he can perform all sorts of actions on behalf of the account owner, or he can convince the account owner to move funds according to the fraudster order. So monitoring the customer behavior and to build a profile of a genuine customer is key to help financial institutions to avoid friction to genuine customers, like I told you before, and on the other hand, to restrict suspicious customer behavior. Like, for example, if we see payments or digital activity outside of the customer usual hours, if we see some spikes in failed login attempts to a particular account, or the number of payments or the payment amount deviates from the the customer's usual behavior and average ratio. If we check failed login attempts that are followed by a successful login and right after a password change to keep the genuine customer out of the accounts, and also biometric patterns that deviate from the customer usual behavior, like the travel mouse velocity, or the number of clicks per session is not the usual behavior of that customer. If we see an unusual scroll velocity, or the velocity between actions, for example, between a login and a payment is not usual, it may indicate that there is a machine that is doing those actions, and other things, like also the duration of a particular session. Moving to the next slide, Santiago, please. So number 3 is device, and device monitoring is of course also a key factor to spot suspicious activity, and again a key factor to build trust around customers and customers' devices. But of course, the customer device is also a potential target for several attacks. Attacks like SIM swap attacks, fake phone apps, or phone hijacking, or even malware attacks. And about malware, we have seen that most of the malware attacks are ransomware attacks, and these attacks are growing exponentially in the last few years. And the goal of these attacks is to block the access to a particular computer or the computer data, and to demand money to release it. And of course, fraudsters usually demand cryptocurrencies as a payment method because of the high level of anonymity, and that allows them to make these payments difficult to track. It is also common for fraudsters to use social engineering techniques, basically just to convince the victim to download a file infected with malware, or just to give the fraudster remote access to the victim's smartphone or laptop. We have examples like fraudsters calling the victim, saying that they are calling from the bank customer service, or they are from some help desk service like Microsoft, and they convince the victim to do all sorts of things, change password, or share credentials, move funds to other accounts, and all sorts of actions. So that is why to work on digital device intelligence is a key factor to allow financial institutions to for one hand reduce, again, this is really important, to reduce friction on their genuine customers, and on the other hand to restrict customers' activity using suspicious devices. And we can see here some examples of suspicious device data. We can see unusual screen resolution, like Santiago mentioned before, or we can see that the device language changed since the last login, or some device type anomaly, like, for example, a mobile device that has an operating system that is different than Android, iOS, or Windows. We can have a flag for jailbreak or rooted device, and also some signs of that device is infected with malware or has a remote access activity detected. moving on to the last key factor, Santiago. Okay, thank you. Well, the last key, the key element of digital trust is IP, and basically IP monitoring, and it is also, like the other three elements, a key factor to spot suspicious activity and to build trust around the customers. And monitoring IP data will allow financial institutions to build a profile of a trusted IP. But we have to take in consideration that IPs can also be target of malicious attacks, like IP spoofing attacks that allow fraudsters to manipulate IP data so that the IP that is being used in that particular transaction appears to be from a legitimate source, or DDoS attacks where several requests are sent in a short period of time to blow a website's capacity and the performance of that website, and opening a window of opportunity for the fraudsters to, for example, hijack banking sessions or taking over the bank account. If we take these examples in consideration, and basically knowing that the customers' accounts can be accessed from non-trusted IPs, financial institutions must be really vigilant and must be careful with signs that indicate suspicious activity. And we can see things like unusual IP location for both monetary and non-monetary transactions, meaning card payments, transfer initiations, but also logins and password changes, and adding new payees. So all sorts of activity during the bank account session. Also, if the customer activity is noticed coming from a proxy server or a Tor connection, pointing to a user that is basically trying to hide his identity. Other things like high amount transactions coming from first seen IP locations that is not the usual IP location for that particular customer, or even spikes in failed logins coming from a specific IP in a short period of time. So we have to be careful with these signs and restrict IPs if we spot this activity. Moving forward, Santiago, it's on you. Thank you.
Thank you, Anna. So key takeaways, and we are a little bit over the time. The first one: banks must look at all the digital trust element available they have to detect and prevent the fraudsters from abusing their online channels. The second one, having the right artificial intelligence and machine learning can help financial institutions to balance the challenging goals they have. So finding the right balance between the customer friction and also silently monitoring their customers for fraud prevention. Number three, financial institutions need to be flexible and able to quickly respond to the demands of their customers and make right investments in technology and partnerships to serve their customers' needs, essentially. And the last one, adaptation is key to survival in the new COVID-19 reality. Banks must build digital trust with their customers and then work in the time to maintain this relationship. I think we have some time for a couple of Q&A, and I see some questions here. Hi, I have two queries. Is Fieldsight hosting clients on its cloud environment? Let's say a bank wants it to be hosted on Fieldsight Cloud instead of on-prem. Is it possible? Yes. Actually, Fieldsight is investing hard on being the cloud platform for fighting financial fraud. So yes, definitely possible to be hosted in cloud. And two, do you guys provide teams for business rule writing and for working on cases, or is it the bank's team that does that? I would say a little bit of both. We have in our offering predefined risk strategy and the way for working with cases and the operational processes for the banks to work, but also is easily for clients to customize, to create new automation rules to work on top of what we have. So yeah, banks and financial institutions can their own logic and rules on top of what Fieldsight offers. There's another one. Should banks use all the elements of digital trust all the time, or is it enough in some cases to just have device or behavior, etc.? I would say the more the merrier. So of course, at some stages of the user journey, there's information that's not available. For example, in the account opening process, there's not much behavioral to leverage. And there will be then some redundancies or things that are good to monitor across all the user journeys. So the device information is not specific on one stage to the user journey, not specific, for example, to the payment initiation, but it's more towards the whole user journey. So yeah, but in general, with the more data we have, the more we will be able to build more accurate profiles, create more rules to prevent and detect fraud. Anna, do you want to add something?
Yeah, it's exactly that. If we can work with more data points and we can leverage data coming from devices, IPs, the customer behavior, it's easier to build a customer profile and not just be focused on just one key element. But we have to make sure we understand the stage that we are looking at, and to see what makes sense at that particular stage. Yeah.
Absolutely. So unfortunately, we are 7 minutes past the time. So yes, thank you everyone for attending. Feel free to reach out to me or Anna through LinkedIn, or just send an inquiry to Fieldsight. And yeah, thank you everyone for joining.
Thank you all. Thank you for coming.